Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. And our guest for this week's show is real estate investment expert, Mark Kenney. Now, Mark is a seasoned real estate investor, entrepreneur, and founder of Think Multifamily. Mark started his real estate career over 25 years ago and has extensive experience in property valuation, acquisition, and operations. And so, guys, with that, it's my honor to welcome back Mark Kenney to the show. Mark, how you doing today?
I'm doing well, Kevin. How you doing?
I'm doing great, my friend. Just
Now we
excited
talked about you look great, man.
yeah, excited to have you here. It's been a number of years. Time flies. I would have guessed it's 3 years. I started looking back. I think it's been like over 4.5 years since I talked to you last. I had you on the show. So time flies, but life is good. Obviously we've gone through a couple turbulent years here in between us last talking. I think we've come out the other side of COVID, but now, we've got some other turbulence that we're working our way through. So excited to chat with you about your business, focusing on multifamily, changes you guys are making, how you're adapting to this ever-changing landscape. But before we dive into the meat and potatoes of it, Mark, what I'd love for you to do is, I gave you such a brief bio there, and I know there's so much more to your background and your story. Maybe take a few minutes and tell our listeners a little bit more about yourself and what it is you do.
For sure. I'm in Dallas now, but grew up in Michigan. One of seven kids, identical twin brother, and we didn't have a lot really growing up. I mean, we had food, place to live, which is great, but not anything extra. So we're like, why we're buying our own bikes at 10 years old, our own tennis shoes and cleats at 13 years old, things like that. I'm like, kind of stinks. So my brother and I, we're the youngest in the family, but we're like, we're going to do something different. We didn't know what it was. So when we were in college, seniors, we're like, everyone needs a place to live. Why don't we look at some real estate? So we started looking at 2 to 4 unit properties, kind of small multifamily, and kept looking and took our dad with us, and concluded actually after a while, my dad, nothing was a good deal for him. So we ended up looking kind of without him, bought a property, and essentially kind of rehabbed it ourselves with some help from other people. We're not real super handy, but we kind of pulled it off a little bit. But that was kind of like we're still in college, and then we both got jobs. We were a CPA for a while, did IT consulting, business manager consulting for the Big Four, and then ended up doing my own. I had my own IT firm, and still continued to buy. Got married pretty young, but small properties. 2013, I've been working for IT business that I started and things like that, 90 plus hours a week, like literally every week. Now, no time off, slept 3 hours a night. And my wife's like, yeah, this is not really going great. You're never here, all that stuff, which I get. So she's like, you need to do something different. I'm like, yeah, my spare time, let's see what I'm going to do. So we both loved real estate for whatever reason. My wife and I both did. And a friend of mine was syndicating the deal, just fancy word for raising money from other people, kind of group purchasing. And I invested passively with my IRA, self-directed IRA. I'm like, kind of makes sense. And then kind of like, if he's doing it, we probably can do it. And, we started getting more involved in that after about a year, looking at a lot of different things. We end up concluding, hey, we're going to buy larger multifamily properties. And then since then, we've done, over 100 transactions, so quite a few overall, 13 states, over $1 billion in total assets. So, but that's kind of a quick background. So definitely jumped from, CPA, IT to full-time real estate investor.
No, I appreciate that. And I don't want to gloss over, being in college and, trying to, figure out a good place to put your money, a good investment. I mean, a lot of college kids are thinking about getting that next case of like Natty Light, right? And you guys are thinking about buying that first investment property. And the interesting thing about that story is that we normally look to our elders for advice, right? Especially like at that stage of our life, like we kind of just assume that they've got 20 years on us. And so they've got more life experiences. They've gone through maybe buying a home before. And so they've got some value that they can bring to the table. And a lot of times we take that guidance, and that might've, shifted you in the wrong path. Right. And because your father seemed to be the one that was the kind of the naysayer, like, nah, like not a good deal, not a good deal.
Right.
You and your friend kind of, took it with a grain of salt. Thank you, Father. Thank you, Dad. Appreciate your advice, but we're not going to take it. Made the decision to buy one. So
it is. And there was nobody else that was doing it. So I don't really know like the turning point, if you want to say, why we decided to do it. But Nobody in our family was really buying, but I can tell you a big motivator for us really was, it's not to be critical. My dad was out working, he was gone sometimes 100 hours a week because he was a firefighter. And then he also worked 30 to 40 hours a week at a lumber yard. So he was gone all the time. And even working as hard as he did, he's always tired. He would come home and have to fix cars, fix washer and dryers, I mean, toasters, you name it, dude.
Yeah.
And I remember, I mean, as a little kid, like I told my mom, I never want to be that way. I never want that. I don't want to be, in that position. So it was a big motivator. I mean, I will say I was 100% literally money driven. That's what motivated me, and changes over time,
Yeah.
hopefully. But
What were the reasons? I just curious. What were the reasons why he felt that was a bad idea for you guys to buy this property? Because I think a lot of folks that are listening, if they're looking to to get out of maybe what they're doing, or they're considering buying a piece of real estate, whether it's just a single family or a small multifamily property, whatever it might be, and if they didn't come from a real estate family, they just came from a family of W-2ers that take the traditional path.
right,
More often than not, they get feedback of not the good kind, that of that's a bad idea, it's too risky, like just all this crap, right? And so I would
right.
love to just be curious as to what were the reasons why your father thought that wasn't the right choice for you guys to be making at that point in time.
Yeah. So, I think looking back at it, he actually liked real estate and actually kind of felt it was probably a good investment. He never, unfortunately, he is one of those guys never took action really, right? As far as he never bought anything, he talked about it. So I think it wasn't the real estate itself. It was just every single deal we looked at, no matter what, even if it was a steal of a deal, he's like, nah, I think it's overpriced. Everything was overpriced. It didn't matter what it cost. So I think it wasn't so much, hey, the actual investment. He was always like, and I think he was trying to do it really, he's always like, hey, he trying to protect us so we don't get in this
Sure,
situation, maybe
sure.
that. But at the end of the day, you have to go out there, take action, do something, and you might not get a steal deal. Maybe you get like a good deal or a decent deal. But he was always, even with cars, he's like, oh, they want, we're buying, no joke, like $600-700 cars, what we bought as kids, right? Is my dad would buy. But if they wanted $700, he thinks, oh, it's probably like $400. It was just, it's always one of those things. And I think it was more, I think also he didn't want us to get in a situation where we had so much work to do on it and things like that. But it was, nothing was a good deal. And we looked for over a year with him in
Wow.
a lot of properties.
Yeah, yeah, interesting. So I wonder if it's just a perception issue as far as like looking at the price of an asset, even if it's a great deal, it's priced right, like it's priced under market, but whatever it's priced at, there's got to be room, right? Like if
That's
we
exactly right.
we pay face value, we're actually not getting a good deal, although you could, in retrospect, be getting a phenomenal deal.
Oh yeah, he told us. I mean, there's several things he told us when we were kids, right? Along those lines, where you just walk away. You never, it's kind of like, well, you can't just keep walking away all the time, because then at some point, you're missing out on things. I'm not saying to go out and just buy something for the sake of buying it, but again, he passed away at 83 years old, never bought a real estate, investment ever. Talked about it all the time. Used to drive by him all the time, look at him, never did it.
Yeah, yeah.
So
Well, I appreciate that, and going back in time, and again, I feel like that stage of your life really set the foundation to where you're at today. And so, fast forward, 25 plus years. Talk to me about what it is you guys do today after you're in the multifamily space. What markets do you like? What size deals are you guys looking at? And I guess more specifically, what does your business look like today? Again, we talked about in the beginning of the show, just some I guess what we felt were going to be turbulent times during
right.
COVID, although like that turbulence actually turned into a phenomenal market for us multifamily owners, right? But now we enter into a different type of turbulence with the Fed keep pushing the rates over the
Sure.
last couple of months, and just the uncertainty of what that road looks like ahead. And so, if you would.
Yeah, for sure. So 100% focused on multifamily as far as, as a lead. I invest in other things passively, other investments, but as a lead, it's all multifamily. I live in Texas. We buy here and we buy a total of 13 states. So Texas and the Southeast. So still like Texas a lot. We were out of the market for a while, out of Dallas, and then kind of as time went on, I think it's getting, compared to some other markets, looks, not too bad. But right after Texas, we went to Georgia, went to Tennessee, Florida. So I don't know. For me, I like Texas a lot. I like Florida a lot, Georgia, Arkansas. We bought, I don't know, maybe 10 deals or so in a couple of years in Arkansas, and I really like that market. They pay their rent and can evict easily and things like that.
Like what part of Arkansas? I mean, really, and when that comes to like someone says Arkansas, I think of really only either Little Rock or like Fayetteville.
Yeah.
Like,
Yeah. So Little Rock, we own the Little Rock, and then like Fort Smith.
got it.
And we've done really well there. We just sold our first two deals there a week ago, and
Hmm.
they performed really well. To your point about during COVID too, they performed really well during COVID too. People paid rents, and I think part of it's attributed to people grow up there, they live there, they don't move, and it's not transient. You know, Florida, Texas, and very transient, or people move in and out. But I think in some of these other markets, people are like, well, if I don't pay my rent and I go down, you know, plus they're small, right? Everyone knows everybody and things like that. So I just think there's more pressure to pay your bills.
Hmm. Interesting perspective. No, that's great. That's great. I appreciate that. And so, talk to me about today. Talk to me about your business today.
Sure.
How you guys are navigating in somewhat turbulent waters with just the ever changing landscape in the capital
Right.
markets. I mean, it's all over the place. It's really hard to get from the beginning stages of a negotiation and actually underwrite it with certain debt in place and feel comfortable that it's going to be that debt when it gets down to right. They're going to be able to lock that in place and
Right.
actually close with whatever terms were set forth in the beginning. So.
Yeah. So definitely has had challenges for sure. And primarily on the debt side, right? As far as rates going up, there are certain things you can do to protect yourself, like a rate cap, which gives you some interest rate protection. They're very expensive right now, but it's just if you're not familiar with it, it's like an insurance policy where
Mhm.
rate can only go up so high. And if it goes up higher than that, you actually get paid. So we have, I think, 18 deals right now that we're getting paid for on a monthly basis because rates have gone up higher than our max, and now we're getting paid monthly for that, which never happened before, but it's happening now.
Right.
I think with the we had a couple months there where most of the inventory, coming out, new deals were pretty much non-existent. It just wasn't. We had bought a lot of deals early, or got a lot of deals under contract earlier in the year and things like that. And we did about 25 deals this year. So, quite a few. But then we saw a couple periods too, even here recently, where a lot more deals started coming out again over the last even couple of weeks. And I think people are like, well, I don't really know people trying to push it either because they have to sell. I mean, I don't think anyone's going to list their property right now and say, let me just test the market, see how I can do, right? There's a reason people are trying to
That's a good
either
point.
their debt, or there's family issues, divorces, partnership issues, sickness, whatever it might be. But, all things being equal, I'd much rather have the rates not doing what they're doing. I think probably most people would agree with that. But right now, we've had to go back in some cases, not so much now, but when the first hike started happening, some of these deals are taking 90 to 120 days to close. And in some cases, our proceeds were getting cut, not like by, 50, 100 grand. I'm talking some cases like, $1.5 million,
Yeah.
$2 million proceed cuts 3 or 4 days before closing. In some cases, we're like, hey, the deal doesn't work anymore. So we've been able to negotiate with some sellers and things like that. And most sellers know that if they put it back on the market, they're gonna, contend with that. But
They'll end up back in the same spot, right? I mean,
right. And start back all over again. So not something we want to do, but literally
yeah.
it's like, hey, we either need to walk out of the deal or we need some sort of, reduction. Now we kind of do know where rates are today, where before it's like it was jumping all over, and they keep going up. They do. There are some fixed rate options. I mean, they're high, but that's one option you can do. And with a fixed rate, you don't really need that insurance policy with rate cap. A lot of people are looking at doing kind of more local type banks, and we're
Mhm.
doing it potentially on a couple refis. And it's either partial or full recourse, which
Right. I
means
was
you
going to
do.
ask you. I was
Yeah.
going to ask you if you're finding non-recourse options with local banks.
Typically not.
Mm.
Not that they don't exist, but if you're not familiar with that term either, recourse is you have personal liability. Non-recourse, I have like no joke, like $800 million in non-recourse debt right now. And if a property didn't perform, lender wanted to take it, they can take the property, but they can't come after me personally. With
Mhm.
the recourse they can. So that's another thing people can look at. The whole thing with underwriting your deal with the highest interest rate it can go to, the max, like with your rate cap and things like that for the whole duration. Hopefully it doesn't have to stay there the whole time. Either goes down or you go into a fixed rate option that's a little bit lower and things like that. Cap rates, people are like, what are cap rates going to do? Like, do you seriously think anyone really knows? I mean,
Right.
people guess, and we've gotten to where we underwrite our deals with a higher cap rate, which means the property's worth less, and a higher escalator than normal. We do like an annual escalator, right? And so we've increased that too to see how does it perform. And then in the refi, I mean, the refi interest rates are a lot higher than they've been. And there are a lot of different options. People are like, why don't you just go into like a Fannie or Freddie? And you can. We've done that before on a number of deals, but leverage is really low. You get no capex money in your loan, generally speaking, and you have potentially a huge prepayment penalty when you sell the deal. We were selling
Yeah.
deals where we had our prepayment penalties were equal to our equity. So let's say we made 120% return, we would have made 220% return
Yeah. Yeah.
if we had, didn't have the prepay. So people look back and always kind of like, we should have done this or this. It's like, you know what? I get all that, but reality is you have to become a smarter investor, as a result of what happened during COVID. We got smarter, what's happening with the rate hikes, adjust. And then people are like, should I just sit on the sidelines? Like, my personal opinion, no. Like, why would you possibly do that? One, brokers have more time than they've ever had before. Right now, they're not as busy, so they have some availability to, kind of build those relationships, things like that. And it's okay. Deals are out there. They probably have to put offers out there. We saw,
Yeah.
discounts. People are going to have different numbers, but 10-15% discounts are, pretty common. Could be more. I mean, might be less. Depends on where they, their starting point is. But underwrite the deal with the higher rates, the higher cap rate, the higher escalator, higher, refi interest rate. If the deal works, then I don't see any reason why you wouldn't go and continue on. Reality is that I don't know where else you put your money. I mean, you can put your money in the stock market. I
Mm-hmm.
mean, I'm not saying you can't do well with it, crypto and all that stuff. I mean, okay. I mean, it's more of a gamble. So I still think, yes, the returns are going to be lower than they have been, all things being equal, but it's still doing really well. We're increasing rents on almost all our properties, like even today.
Mm-hmm.
The occupancy is last September. So occupancy was 96% across the entire country. Renewal rates are up like I think $125, which doesn't sound like that much, but that's like $30,000 of value at a five
Yep.
cap. So with the single family basically getting pricing out the ownership for a lot of people because the rates are so sky high, people are coming in and doing more during multifamily. So it performed well when times were great before COVID. It performed well during COVID, and overall, it's performing pretty well right now. Not as well, I don't think, really, because some of these rate hikes, if you don't have the protection and the rate goes up 200 basis points or 200, I
Yeah.
mean, it has an impact on cash flow.
Yeah. Yeah. Well, let's talk about, I mean, even speaking to the, it's interesting with these rate hikes also made it for the, the end consumer that was the would-be home buyer, right? They got
Right.
priced out of the home buying market. And so they,
Right.
are they would-be home buyer that is now a, need to be renter. And so,
Right.
um, interesting dynamics there. I see a lot of builders have slowed their production, and we're still got a massive shortage in this country. And so, there's all these interesting dynamics that are kind of taking place. And again, no one's got a crystal ball as to how this all really plays out in the end. But what we can see is that there's still a significant demand for quality, affordable rental housing, and multifamily is a very safe place to place your money, and with not necessarily a ton of concerns of volatility, right? And
Right. And there's other
outside of,
benefits too, right? Like depreciation could be out,
absolutely,
things like
absolutely.
that. But I'm with you. Is it, it's as good as it was, 1 year, 2, 3 years? No, it's not, but
Well,
it's still,
you made an
better.
interesting point of and I don't recall exactly how you stated it, but basically anyone that's selling today, not maybe everyone, but like you would have to guess or have to assume that a percentage or a good percentage of the folks that are selling their assets today um, know that if they would have sold 6 months ago, they would have probably been able to time the market much better. Probably would have realized significantly higher sales price and more competitive offers than what they're going to get today, given this inflated capital market or debt market. And so, you know, why wouldn't they just hold on if they got the time, assuming that it's not like a term issue with their loan? They got some time to kind of play this out. Why wouldn't they? And so one would have to assume that maybe their loan terms coming due. Maybe it's a
Right.
partnership dissolution. Maybe it's the property's owned in a fund and it's at the sunsetting
Right.
point. To where they
Required
have
to.
to actually sell out. So That's a good perspective. I had not considered that of the deals that come across our desk. That there's more than likely there's probably an underlying reason why they actually need to sell, even though that they probably realize it's not the best time to
Right.
sell given where debt's at. So very interesting perspective there. And so have you seen just generally speaking, have you seen seller expectations start to readjust a little bit?
Oh yeah.
And broker expectations as well. Have they readjusted to where things are actually, you could still make things pencil with the debt that's available today?
Yeah, so brokers for sure. I mean, in some cases, they're like, just put an offer in, which we wouldn't hear before a year ago, right? I mean,
Right, right.
they're like, you need to be at this price or higher, Um, but yeah, I think that looking at even the offer process before, 6 months ago, we were putting up significant earnest money. I mean, significant, just to be competitive, right? A lot of, in some cases, we had to put like hard money up, which means we might put money up that we would lose if we didn't move forward. And there are just things like that. And then all of a sudden, now we're getting like early access agreements on any deal, which means we get in to look at the property and physical and financial due diligence before we even sign the contract. We're putting much less earnest money. We're putting no hard money up day one.
Okay, I was going to ask you that.
So
Hard money
we're
day one.
not.
That was the thing. I mean, if you were going to be competitive, like you pretty much had to be willing to come to the table with hard money out of the gate, correct?
Yes, and you're in some cases you're talking 500 grand. I mean, it's big numbers, right? To walk away. So seeing a big shift just on the whole like offer process. So being in tune with what's going on is helpful. So that's one. And then yeah, I mean the whole expectations of sellers, they're much more willing to negotiate because they know as is right now, as time goes on, pricing probably will go down in some respects. It will eventually go up. Put all my money and I have that real estate will go up some point in time. When, I don't
Yeah.
know. But a lot of the sellers' expectations have changed a lot, and they're willing to work with us a lot more than they have been before.
Have you seen that the number of bidders, so like in any particular offering that you might have an interest in submitting an offer on, that maybe a year ago there was 25 people putting an offer in, and now today it's half of that. Have you seen a reduction on the total number of interested parties?
For sure. I will say that, it's probably like you said, half the people are sitting on the sidelines, which is, good for the people
That's a
active,
quick.
I think.
Yeah, I want to hit that point. So I would love to, again, we're making some assumptions here, but I would love to hear, kind of what your thoughts are on those groups that might have been a buyer 6 months ago, that might have been competitive buyer 6 months ago and been your competition. What do you think some of the reasonings, or what have you heard as far as chatter as to why they've made the decision to just step onto the sidelines for the time being?
Well, a lot, yeah. Let's say, well, we don't know what the market's going to do. Well, of course, no one does. But I'm always of the opinion that, well, we kind of know right now how to underwrite deals. I mean, I don't say worst case scenario, but it's kind of worst case scenario unless the lender, cuts proceeds right at the last minute, which they could do. But kind of worst case scenario, does a deal work? If it works, I don't see why you wouldn't move forward on it.
That's
People are like,
right.
well, I think we're paying too much for it. Well, make offers that are lower. Make an offer that actually works
Yeah,
and see if it gets in there. So people did the same thing during COVID. I mean, I was on a bunch of podcasts saying, I don't know if we're going to buy, but we're going to keep looking. And we bought, whatever, 24 deals last year as well. So other people are like, well, I just don't want to, get involved in this because I'm scared. Well, I get it, but you can do things to mitigate that risk. And like to your point, I do think a lot of the offers, number of offers come way down. I think if a property is kind of like a property is attractive though, there are a lot of offers. I mean, still like 30
hmm,
plus offers in some cases on deals. And we've
gotcha.
sold a lot of deals. We sold 12 deals last year. We'll sell about that many this year. And we've had a number of offers on our deals we've sold.
Hmm. Have you guys readjusted? Like, is your what I guess what's your standardized kind of hold period look like? And I know every deal is a little different than the next, but just generally speaking, is it a 3 to 5 year hold? But again, and I know that some of those holds were accelerated, in the last couple of years
Right.
with where prices went. So what's going to be maybe a minimum 36 months, like we could achieve that same IRR at 18 months, and so we're going to exit
Right.
out of it. So what does that look like today for most of the deals you guys are buying?
We'll typically underwrite it 5 to 6 years and didn't tell investors. And we always get asked, could you sell sooner? Yes, we could. Sold deals in, 14 months and things like that. We could hold it longer too if we get to the point where it doesn't make sense. But we
Mhm.
underwrite it still 95% of the time at a 5 to 6 year deal. There are some that are, I don't want to use the word flip necessarily, but kind of, 1 or 2 year we've underwritten. And there's certain reasons we think we're getting the cost basis is really low. Cash flow is not there. So it's really just a value play. And those would be closer to like a 18 months to 3 year hold.
Got it. Got it. Have you guys done any new development, a ground up development?
Just once. There's no reason we haven't really, just haven't gotten involved in it, but we did it on a
Mhm.
property that we did own. We sold it, and there was a fire there years ago. We built like 29 new units, and it went well.
Mhm. Okay. I've seen a lot of syndicators that, for the most part, 90% of the stuff they did over the last couple of years was all, BC value add stuff that are ultimately, kind of flipping their script a little bit and really putting an emphasis on buying either, directly from the developer or, something
Right.
that's only a couple years old. I guess I'd love to hear your opinion or perspective on that shift of that model from the BC value add stuff to buying the newer vintage, sometimes brand new class A stuff.
Definitely support that. Now, whether it needs to be brand new or, let's say 90s plus, I mean, still kind of old, but I can tell you we've done a lot of distressed deals. I'm talking like 0% occupied, 25%
Wow.
occupied, things like that. And not that you can't do really, really well on those. Some of them made like just tons of, on the return side of them, but the headaches associated with it personally, the amount of money that you're waiting for the lender to reimburse you, some cases, hundreds of thousands of dollars. You're having to pay vendors, waiting to get paid for months and months. You put money into a property and then, people come in and vandalize it. We had one property had like $1 million of, damage to it that we had, redone and everything. So I'm done doing those properties. I am. I mean, I'm not saying they're not great for someone maybe that has a real construction background, loves that stuff, but I'm a big supporter. If I look at, we've done 104 transactions. So I look at the different transactions, say, which are the ones that cause the most headaches? I would say
Yeah.
reality, the biggest returns though, too. But a lot more risk, there's no cash flow. So I do think looking at like you want to say nicer assets that are more highly occupied, maybe the returns, on paper are a little bit lower, which they will be because risk adjusted. But I'm a big supporter of that actually.
Yeah. No, it's interesting to speak to the heavy value add stuff. We've done some really, really big lifts over the years, and it's again, you might knock it out of the park with the overall returns, but what if you look at the time, energy, and resources that it took you and your team to
Right.
to actually achieve those results, that and then what other deals you had to pass up on that cumulatively would have probably got you even further ahead within your
Right.
business. And it's I think once you do, like, I think everyone kind of needs to go through that motion, because I think when you look at a pro forma on a deal like that, you're like, I can buy it at this basis. We're going to do a
Right.
complete renovation. It's a great market. I know that the demand's there. If we actually clean this place up, like, we'll definitely, you'll be able to lease up those units. You don't take into, you don't take into consideration some of the other challenges, like it's got a bad reputation. So there's like, bad elements hanging around there still.
Oh
They're going to
yeah.
steal stuff. They're going to steal air conditioners. They're going to
Right.
vandalize units. And then the reputation, it's hard to overcome that when you're first doing a lease up. Even after you make the place look pretty, it still has a bad reputation. You got to get some people to take like the leap of faith and be the first, like, 10, 20, 30 residents to occupy units. And, like, there's all
Right.
these like barriers you got to overcome. And
Oh yeah.
when you get to the end of it, hopefully it's turned out well. Probably had some unknowns that hit you along the way, that cost a little bit more than expected. It took a little bit more time than anticipated, and but you start looking back, you're like, damn, life's too short to
I agree.
life is too short. Yeah, like, come on, let's just do let's just do some better quality deals. Maybe not hit home runs, but let's just hit a bunch of doubles. I mean,
No,
if we hit a
I
bunch of
agree.
doubles, like, our batting average overall is going to be way better anyway. So, and we'll have
Right.
better residents right out of the gate, less gray hairs.
Yeah, I don't got a lot. And I think it's, maybe it's the older you get too, right? You're like, man, I just don't want to deal with that anymore. But
Yeah.
yeah, I support that for sure. We bought some nicer assets. And I'm for one, doesn't mean we'll never buy B's and C's and things like that, but the distressed deals, the big difference between a, just a regular C asset and a distressed deal. The distressed deals I'm not doing anymore.
Yeah. Yeah. No, I agree with you. No, switching gears here before we wrap things up, Mark. I'm gonna switch the gears over to we're talking more about like operation side from from the principal's perspective, from us running our companies, kind of how we do deals, what we're looking for. I'm gonna flip it over to the LP side, to the limited partner side. We get we kind of have a mixed bag of folks that listen to the show. A big portion of them are active guys, just like you and I, just really trying to learn the latest and greatest strategies to implement into their own business. And then the other side of that equation will be the high income earners, business owners, folks that are, not necessarily, they don't want to get into the trenches like you and I are, but they ultimately want to put money into these, various types of assets, and are just really trying to find the best jockey to link up with. And, now, it just seems like there's such a busy sea of syndicators out there, right? Like it's almost overwhelming. It's funny. I
Right.
compare it to podcast. I started podcasting almost 9 years ago. Back then, there was maybe 20 real estate podcasts, and that might even have been a stretch. Now, like I don't even know if I don't even listen to podcasts hardly anymore, because it takes so much time to filter
Right.
through all the new stuff that's out there that I end up wasting hours not finding anything that I want to listen to. And so it's frustrating. And I feel like
Yeah.
it's very similar to the amount of offerings that are out there. And so what advice would you give some passive investors that are just starting down that journey and they're trying to find the right syndicators to place their capital with? Any advice?
Yeah, I mean, even prior to that, make sure you at least have an understanding what you're investing in. I get called all the time. People are like, "Oh, I got called last week. A guy said he invests like $600,000 in like 8 deals, and I mean, it was like a few months." And he's like, "I'm not really sure. I really know exactly what I'm doing." So you don't have to be the expert, like you said, day in, day out of Excel, but at least first understand kind of what you're investing in, what to look for. As far as syndicator, how long they've been doing it. Are they full time? Are they, I would say, even if they're full time syndicator, I think you need to have a full time asset manager.
Mm-hmm.
We've done different models, and it can be tough to try to be asset managing properties and then trying to find deals, and it takes time away to do that. And then ask them questions like, hey, what do you like about the deal? What you don't like about the deal? I mean, almost every deal I've bought, there's something I don't like about it.
Mm-hmm.
Right. So if someone's like, well, there's nothing I don't like about it at all, I mean, that's probably pretty rare. And then if they had issues, right? I mean, you ever had an issue? How'd you get around it? What'd you learn? Have you had a loss before? But I think, how long someone's been doing it, how many transactions they've done, how many they've exited, and then their commitment as far as like, is it full time or not?
Mm-hmm.
I'm not saying a lot of people that are syndicating there, you have W-2s, can't do really, really well, because they can. I mean, most of us started there, but I do think there's something to be said. Someone's doing it full time, and
Yeah.
I mean, I look back at you doing 100 plus transactions and going, my goodness, I wish I knew 100 transactions ago what I know now, but I
Absolutely.
didn't. And then what mistakes they've made. When they learn from them.
Yeah. No, that's all great insights. No, absolutely great advice there. And, it's just, again, there's so many options out there. I think, the interesting thing to me about a number of not all passive investors, but like there's a contingent of that group that I would guess that probably doesn't even read through like the offering. They
I
don't read
know.
through the PPM, right? And I just getting a you know basic fundamental understanding of the waterfall structure, and what the prep structure looks like, and what's the return of capital in that particular deal, like how does the capital flow, from the sponsors back to the LPs, who gets paid first. I mean, there and it's not overly complicated. I'd say
No.
90% of PPMs, it's all just standardized material. There's really
Right.
only 10% of it that you need to be spending a lot of time in, and just having a firm understanding. If you don't have an understanding of it, you know, spend some money. If you don't have a CPA, spend some money, get a CPA, and spend some money, find a decent real estate
Right.
attorney, a securities attorney that can maybe put it in layman's terms, or maybe have an
Right.
outsider's perspective. It's worth the 1,000 or 2 you might pay for that advice. If
Right.
you need someone else in your corner, right? Like, you can pay for it. That's a good thing. Like, you can pay a couple experts to provide some additional context or their opinion or perspective on whatever it is you're considering investing in. So, especially if you're going to spend $100,000 into an investment to drop
Right.
1,500 bucks, come on, like, it's not worth being that cheap to not want to spend the money to get some expert opinions.
I
So
agree. The structure and the fees, right? Those are the
that's
two
it.
main things. And then control.
Yep.
The average limited partner isn't making, really hardly any decisions at all. So you have to go into it, it may be the PPM says you can make certain things, but like a lot of them, you can't vote on when you're going to sell a lot of cases or
Mhm.
refi or things like that. The managers, you decide that. So you either accept that or you don't, but don't get to the end and go, well, I'm trying to vote to sell. And it's like, well, you don't have a vote,
Right. Right.
so those type of things are, very important to understand. And we have a list of questions on our website too. You can ask,
Okay.
syndicators and things like that too.
Mark, for those that want to learn more about, you and your team and what you guys have going on, where's the best place to find it?
Just email. It's Mark, MARK at thinkmultifamily.com. That's the best way to get a hold of me.
Okay. Well, fantastic. Well, Mark, it's been a lot of fun having you here. I appreciate you coming back after many, many years. I'm glad to hear that things are going amazing for you and your team. And yeah, to say keep at it as we can roll through these turbulent waters here, and look forward to
Sure.
hopefully getting an update from you. Hopefully it's not 4 more years, but well, more than
Right.
likely our paths will probably cross at a conference at some point now that those are happening again. So, but anyway, buddy, it's been good seeing you and good having you back on the show.
Thanks, Kevin. I appreciate it.
Alrighty, guys, that's all we have for this week's show. And so until we meet again next week, this is your host, Kevin, about wishing you huge success. Take care now.